The permanent, portfolio fund has been a top performer over the last 5 years, offering investors annualized returns of nearly 10%. Michael Cuggino is the manager of the permanent portfolio fund, and he's also the president of the permanent portfolio family of funds. And he joins us now with his strategy and stock picks for this year. You know, Michael, thanks for joining us here live. You're based out of San Francisco?
Yes.
Well, let me ask you, not a good day to come to New York, by the way, but this winter has been a tough winter. But let me get to the point here. You're not just a stock investor, you're actually in a number of asset classes.
Yeah, our permanent portfolio fund invests in a wide array of different asset classes, not only stocks and bonds and cash, you know, the traditional Wall Street model, but also commodities, natural resource stocks, real estate investment trusts, U.S. and non-U.S. equities and bonds. So we're spread out along a wide variety of areas. The idea being that the broad array of different asset classes provides investors downside protection as well as an ability to profit in multiple market environments.
Right. Well, you're very broadly diversified, but before we get to that, let's talk a little bit about performance so far. You know, you have a great 5-year track record, but so far this year, it's been a rough start for the fund.
Yeah, it has. I mean, there's been some profit taking in some of the harder asset stocks as well as precious metals like gold. Obviously, gold has sold off almost 100 points maybe since its highs, which doesn't even meet the definition of a correction, really, a trading range, but it has sold off nonetheless. Keep in mind, though, it's gone up quite a bit 6 months before that. So, you know, we're long-term investors. A 2-week period, a 3-week period, really in the overall scheme of things means nothing to us.
All right. Well, let's talk a little bit about the asset allocation, big picture here. You know, this is based off of a report from the end of the year. It looks like you have close to 20% in cash right now, or cash equivalents. Is that true?
Cash and cash equivalents. By cash equivalents, it's typically treasuries under a year to maturity. So, you know, more of a cash equivalent. It's not just cash sitting in the bank.
All right. You got about 28% in U.S. stocks, a little bit non-U.S. stocks, and 26% in bonds, and about 26% in the category we're calling other. I wanted to dig a little deeper into the assets themselves. You know, you have a very diversified portfolio. You've got gold, silver, Swiss franc assets. You've got mostly U.S. stocks, but you've also got some foreign real estate, some natural resource companies, and then you've got some fixed income. But let's talk a little bit about the gold and silver play here. Yesterday we were talking about Chinese GDP coming in very, very strong, fears of inflation, sort of unsettling a number of investors around the globe. And that's also hurt commodity prices so far this year. What is your thesis on gold and silver going forward?
Well, I think we're in a trading range on gold, and we're obviously at a lower end of that trading range than we have been maybe by the end of calendar year 2010. My view on gold in the long term is that it's going to go higher highs and higher lows. And I would point to the macro monetary policy environment out there, not only in the United States but worldwide. We're creating a lot of paper money. I would point to increases in demand both on the retail side of things, especially in the emerging markets, with disposable income buying jewelry for consumer demand, as well as gold has become an investable asset class in the last decade, both by hedge funds, individuals, mutual funds like ours, other institutions, as well as governments, sovereign wealth funds, et cetera, diversifying credit balances and such. Real interest rates are negative right now, which has traditionally been a bullish sign for gold. And last time I discovered, gold isn't as plentiful as water. So, I mean, supply is still somewhat constrained. And I think all of those things combined make it such that we're going to see a continued rise in gold, just given that macro environment that's out there. But it's a volatile ride, as we're seeing.
Yeah, exactly, which is why, you know, looking at it on a monthly basis can be dangerous in terms of fund performance. Let's talk about Swiss franc assets.
Sure.
What are you investing there? These are assets denominated in Swiss franc, as opposed to, is this a little bit of a currency play or more of a pure asset play?
Well, it's both. It's, you know, again, our broad idea of comprehensive diversification. We wanted a currency in the portfolio that weighs against or anchors against the U.S. dollar. And we felt the best risk reward out there was the Swiss franc. You know, the safety of the franc, the lack of desire to expand the currency, lack of government spending, property rights, rule of law, et cetera. You pay a premium for that currency, but it's a relatively safe non-U.S. currency, almost like a harder asset kind of currency. So basically, we invest in the currency itself and Swiss government bonds typically.
All right, let's quickly go through. We don't have too much more time, but let's talk about the U.S. stocks that you like. And that's really, we were saying this during the break, that's how you get your sort of overseas exposure, is really through U.S. companies that are doing business overseas. We just saw the president with Jeff Immelt talking about the importance of that two-way street. I guess a good example example, I know it's one of your favorites is FedEx.
Yep. Obviously, the transport sector, if you factor in, or if you believe in the global growth story, which we do, and an improving U.S. economy, volumes increase, more transportation, more business activity, higher volumes. FedEx has some pricing power for their transportation services. Non-U.S. businesses are growing actually even faster than U.S. businesses for FedEx. So we think it's a good long-term growth story out there.
And there's certainly a leader in that industry, right? There's if you think of a name synonymous with that business. Let's talk about State Street.
Yeah, of a bank, although not a bank in the traditional sense. It's sort of a servicer to the asset management industry. Very efficient operator. Don't have the real estate issues that maybe some of the other banks have out there. They put their problems mostly behind them and written them off and taken whatever charges are necessary. Very efficient management team. Likely to institute a dividend increase. They've been considered one of the banks that's too big to fail, which philosophically I may have issues with. But they are a significant player in the asset management industry, and we think it's a great long-term holding as well.
All right, Michael, thank you so much for joining us. Have a safe trip back to San Francisco. Hope it doesn't snow before you get on a plane.